Welcome, dear traders. This week we'll offer a lot of important economic data and interest rate decisions from several major central banks. In addition, the corporate earnings season continues with the AI stocks in the spotlight, as the antibody currencies are sensitive to the movements of the US stock market, and they showed high volatility at the beginning of Monday's trading session. Other factors affecting the Asia-Pacific markets and investor sentiment are also worth considering. China, the region's leading economy, continues to face problems on several fronts at once. Last week, the Chinese stock market fell to a 5-year low, and such a sharp decline raises doubts that the government funds are artificially propping up stock indexes. Annual foreign investment inflows into China fell for the first time since 2012, according to the Ministry of Commerce. They totaled about $157 billion, down by 8% from a year earlier. The fragile economic recovery after 3 years of lockdowns forced investors to look for other markets to invest in. Beijing still seems reluctant to take aggressive stimulus measures. For example, the People's Bank of China left the benchmark interest rate unchanged for both 1-year and 5-year terms today. At its meeting tomorrow, the Bank of Japan is likely to keep the interest rate unchanged. Other regulators, including the European Central Bank and the US Federal Reserve, are not expected to change their stance in the coming days. Another question is how the markets view the prospects for further rate moves. For example, the FEDWATCH tool showed that markets were expecting a US rate cut in the first half of this year. However, strong economic reports and hawkish comments from the US Central Bank policymakers forced investors to reconsider the expected timing of the first rate cut and postpone it a month later. As for this morning, 43.5% of the market is pricing in the probability of a March rate cut, compared to over 84% in May. Despite the seemingly distant prospects of the regulators' auctions, the US dollar is already suffering losses. And today, in the Asia-Pacific session, the greenback has plunged from the 5-week high reached on a Friday against 6 major currencies. Stronger than expected US economic data and aggressive signals from the US Federal Reserve officials boosted the yield on the US Treasuries and helped the greenback to strengthen. And today we see the US dollar index slipped to the area of 103.20 during the Asian session. The greenback is struggling to hold until last week's gains, trading within the 103.10 and 103.30 range. Given that there are no important reports on the US economy today, the bearish trend may drag the US currency into the support area of 102.00 and 102.60. In particular, the Fed will remain silent until its decision next week. In the meantime, the greenback will be under the influence of the European and possibly Japanese regulators. This is all the more likely in the light of today's speech by the head of the European Central Bank. In her previous statements, Christine Lagarde has maintained a hawkish stance. As a result, the euro may put pressure on the US dollar at the beginning of the week. The US dollar weakness combined with the drop in the US Treasury yields helped the dollar-yen pair retreat from Friday's highs to the 148.10 level today, and the yen also strengthened within the range of 147.70 and 148.30 early Monday, amid further escalation of geopolitical tensions in the Middle East and economic problems in China. However, its safe haven appeal does not appear to be as massive as that of the US dollar. Moreover, the recent earthquake and weak domestic wage growth data confirmed that the Bank of Japan is highly likely to leave its settings unchanged tomorrow. In the coming months, the Japanese regulator is unlikely to abandon the 10-year adjustments regime. The yen will continue to be driven by government bond yields, and today government bond yields rose in Japan, while US Treasuries dropped due to the alarming geopolitics. Therefore, the dollar-yen pair remains in the bearish zone and may test the support zone of 147.70 and 146.50. The next technical resistance level is located at the 148.30 mark. However, any yen gains will be held back by the Bank of Japan's ultra-loose stance. The Australian and New Zealand currencies were boosted by a revival in the risk appetite on Wall Street and a rally in the US equity indexes on the back of technology stocks. However, the escalating conflict in the Middle East and the disruption of oil supply routes through the Red Sea led to uncertainty in the oil market. In addition, the threat of a lower global demand for commodities is increasing against the backdrop of China's weak recovery. As a result, commodity assets, including the Australian currency, initially soared but then dropped along with the oil prices today. At the same time, subdued domestic economic reports added to the pressure on the Aussie. As the Reserve Bank of Australia may make an early rate cut, the situation remains difficult for the Australian dollar. As a result, the Aussie showed high volatility in the Asian session, trading within the range of 0.6580 and 0.6610. At the same time, the Aussie fell below the key level of 0.66. However, technical indicators continue to give bullish signals. As such, the Aussie may test the 0.6650 and 0.6670 resistance area once again. The support level is located at the 0.6520 mark. The New Zealand currency gained momentum in the early hours of Monday's Asian session, climbing to the upper boundary of the intraday range of 0.6100 and 0.6140. Because the Kiwi was maintained its bullish trend, the pair may hit the high it has already reached today, breaking through to the 0.62 level. At the same time, the Kiwi dollar pair is unlikely to test the weekly high of 0.6250. Most likely, investors will prefer to wait for Wednesday's inflation data to understand the prospects for future decisions by the Reserve Bank of New Zealand. And that's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below, and see you online soon.